Let's just kick things off with where we are with this debate, because it's almost as though the investors out there in the markets are really trying to tell the Fed something, aren't they? And it's at odds with what the Fed is thinking, and the Fed's mantra has remained pretty much static.
Look, I think the market is nervous partly because so much of what's driving assets is obviously central bank liquidity driven by the Fed. So people are going to be sensitive to what extent this data can surprise on the upside. But I have to say, I mean, we already had, surprising upside on CPI, core CPI in the U.S. last month, and the market didn't react that much. I think there's a little bit more growing nervousness that some of these supply-side driven inflation pressures may spread out and intensify. But I still think the view is if it's mostly driven by supply-side factor, which is what we're expecting in this upcoming April CPI inflation reading, even if you get a month-on-month core increase of 0.3%, or even it might round off to 0.4%, I'm not sure that's going to move the needle in the reaction function of the Fed. However, the one thing I think people are going to be mindful of, which also may challenge the Fed's narrative of the transitory inflation pressure, is really what happens to shelter prices. We seem to already be seeing a pickup of shelter prices since around February. And, again, if rent and owner-occupied rentals continue to rise, and that is something symptomatic of the kind of the booming housing market in the U.S., that may be something that the Fed may not be as willing to look past through. But I do think, I don't know, my view is that it's going to take a lot of inflation readings to change the Fed's view on its path to policy. And I'm not sure this upcoming Fed, inflation print is going to change the needle. So again, market's nervous, but by and large, probably be biased to fade this nervousness. I think, the base effect on inflation, that's already pretty much expected. Supply side, okay, that's, even though it could surprise a little bit, that's transitory. So I do think that the hurdle for the Fed to change its tune at this juncture is still fairly high. And the one that we really need to watch is what happens to non-farm payroll. And as you know, we got a reprieve from that last week.
Johanna, okay, I think what you're talking about here is a supply-side driven inflation, which could be transitory. But if we do get all these checks landing on people's doorsteps as they are, that can induce also demand pull, can't it? And that actually then could create a circle where we do get inflation for longer.
Well, there's always a risk, right? And the question is, what's the size of the stimulus relative to the output gap in the economy? And if you have the likes of Larry Summers saying, the size of the stimulus is so large, we should be much more worried about inflation. But I think on the flip side, you do still have some kind of scarring effect, some kind of slow recovery in the labor market. As again, the Fed will argue, it's above, still maybe over 8 million people still out of jobs relative to where we were pre-pandemic. So again, I agree that there are certainly rising risks. But at this juncture, the view is it's still transitory, that we still have sufficient output gap at the moment, and that will curtail the ability of companies to pass on a lot of the input cost pressures on higher consumer prices. We have a very uneven kind of global outlook recovery, elsewhere in the world. So, again, it's going to take a while, but I do think, our view is eventually the Fed cannot deny that inflation is picking up. But we are not expecting them to maybe turn a little bit more hawkish. Again, we're assuming it may happen sometime in the summer. So I certainly think there is certainly a risk. But I'm not sure this upcoming CPI print is going to be the make it or break it for the Fed. I do think we need to see a series of stronger non-farm payrolls for the next couple of months for the Fed to kind of move towards tapering and signaling of tapering by the end of the year. Well, they'll signal in summer to start moving by the end of the year. That's kind of our base case view at the moment.
So the Fed looking at jobs, and it wants to create 6-7 million more jobs so that we get to full employment. How will wages, though, play out in inflation? I mean, we're talking about a possible $15 minimum wage as far as the Biden administration is concerned. How will this play out in terms of the inflation story?
Look, obviously, wage is an important, wage growth will be an important determinant of how core CPI inflation trends continue to pick up over the medium term. Our house view right now at this juncture is we're not going to see a sustained wage spiral despite the stimulus that we've seen, partly because I think, there's a lot of other factors that are kind of suppressing that. We've got globalization, we've got automation, we've got digitization. There's also a question of how much of this stimulus that we've seen, the one that's more for consumers and sort of the outlay for unemployment, expanded unemployment insurance, how much of it is a permanent fiscal outlay and how much of it will be dialed back and is transitory. So right now we have this huge fiscal stimulus. Of course, the question is whether they're going to continue that going forward. The next piece of legislation on U.S. fiscal stimulus is more supply side, more infrastructure, and it's more partially tax funded. So it's a different kind of composition to what we've seen in the beginning. Our view right now, our view is that yes, we're going to have high inflation, kind of above target. I think average about 2.7%. We may still be above target in 2% next year. So therefore, the Fed continues to normalize. But beyond that, we may be settling back to the kind of Fed inflation target. So there's no need to do something very abrupt. But I do think the market is understandably nervous. We've had easy liquidity for so long. So I think the path to normalization, we don't know, we've never been in a pandemic in recent history. So trying to figure out the path of inflation and how much this upswing moderates and the pace of moderation is going to be a challenge for the market. So we should be up for a little bit, prepared for some volatility going forward.
We saw China's PPI beating expectations, and some data suggests that there is a strong correlation between China's PPI to U.S. consumer prices. Your take on that?
I think, obviously there are some factors that are global inflation, but we have to remember the big driver people are looking at in the U.S. in terms of CPI inflation dynamics, aside from what's happening in shelter prices or in housing, is service prices. And those sectors are much less tradable. Services sector, what's happening to housing, of course, there's some component to housing that are driven by commodity prices, but at least on the service sector component, which I think is the one thing we're watching for this next CPI inflation print, whether we're going to see things like accommodation prices, transport prices pick up, those are much more domestic. Now, in the case of China, as you can see from the print, right, we have kind of high PPI inflation. A lot of it is driven by supply side issues, some of it from the decarbonization push we're seeing out of China. But we still have pretty muted CPI inflation. We still have, even food prices have been moderate, but even non-food prices have been moderate. And I think that tells you that, even China, which has been more advanced in the recovery post-pandemic, we're still seeing kind of an relatively muted and kind of not a big issue in terms of CPI inflation. So I do not see that as a game changer for the outlook of PBOC's policy.
Johanna, just tell me very, very quickly about U.S. exceptionalism and that tied with the recent spate of dollar weakness, particularly against some of the majors.
Right. I mean, I think in the beginning of the year, dollar strengthened because so many things were going in favor of the dollar with the huge stimulus, with the vaccination program. But as we were seeing now in the data over time, we're starting to see some catch-up vaccination, especially in Europe. So the gap of U.S. outperformance and vaccination is stalling. As you see, vaccine take-up is also slowing down. And at the same time, I think, we've seen a bit of reprieve in U.S. Treasury sell-off. So although we're seeing rising inflation break-evens, nominal yields have not really gone up at the same time. So real yields in the U.S. are softening again. So because of this catch-up in sort of European, kind of the rest of the world momentum relative to U.S., and because the Fed has persistently stayed dovish, allowing real yields to head lower, that's part of the reason why we're having a bit of a dollar weakness. So our view is in the 3 month to 3 month horizon, we still have a bit of a dollar weakness view. Now, the question is, because our assumption is by summer, the Fed will probably have to turn its tune and start signaling a taper, that eventually, the U.S. growth resilience will persist longer, that by the latter part of this year, this European catch-up may settle down and U.S. might actually still look relatively better. And if the Fed starts to turn a little bit more hawkish, we may get a resumption of dollar strength in the 6 to 12 month horizon. So we are in the short-term window of a bit of dollar weakness just because of this kind of catch-up trade we're seeing. But again, the Fed is the critical factor here in the view of the dollar. If we're wrong and the dollar is far more committed to keeping things loose for much longer, then our view of a short-term dollar weakness could extend itself. But right now, that's not our house view at this juncture.